Market concentration has been a pretty frequent topic in the capital market media over the past few years. One way we can look at that is to compare the performance of the S&P 500 with what's known as the S&P 500 equal weight. So differences here, the S&P 500, the one that you're used to seeing more frequently, capitalization weighted, which basically means each company is weighted by how large it is, by its market capitalization. So the largest companies get the largest weight, and that winnows down as you get smaller. Equal weight takes those same 500 names and says everyone's equal. So it ends up being about 0.2% per name. Main difference you can just see in the top 10 names. So in the S&P 500, top 10 are about 36.5% of the index. Largest name, NVIDIA, is over 7.5%. Whereas you move to the capitalization weighted, again, every name is 0.2. That will fluctuate somewhat as time goes by, but it gets rebalanced back to that 0.2. So that's the central tendency there. So top 10 names would be 10 times 0.2. So much smaller there, right? 2% as opposed to 36.5. So what we see is over time, really kind of a changing leadership. So sometimes cap leads, sometimes equal weight leads. Typically, we see capitalization lead during up markets. So think late 90s, the initial rebound coming out of COVID, and certainly what we've seen the past couple of years here. Whereas equal weight, when things get a little more dicey, a little bit more uncertainty, that segment tends to do better. If we go back over time, again, they change and the leadership is different. But if we look specifically at our most recent period, so starting at the end of 2022, beginning of 2023, through October of last year, we see that cap weighted outperformed by over 40% to the tune of about 12% per year. It's a pretty typical margin of victory, if you will, relative to those other periods I discussed. So nothing too out of the ordinary, except for it was just a little bit longer than some of those other periods of outperformance have been. Since October, things changed, though. So we've seen a rotation in leadership, and we've seen it in a number of different areas, and we'll cover that as we go along here. But we've seen the equal weight outperform the cap weighted by 8%. And so you see that on your screen here. So that line pointing down, that negative number, means that cap weighted is outperforming. But what's been interesting is it's done it by being positive. So the S&P isn't down, it's just essentially flat over that period, but the cap weighted index is up. And it's been due to that rotation. So we've seen smaller sectors in the S&P 500 be the best performing sectors, which means when we move over to the equal weighted, they have more voice, if you will, in the return. Whereas something like technology, which is the largest weight in the S&P by far, has been one of the worst performing segments. So it's pulling that back, whereas these other sectors are pushing forward an equal weight index. We've seen it in growth versus value. So 7 weeks thus far in 2026, 6 of those have seen value outperform, including the last 5 straight. Same story for capitalization. Small cap outperformed 6 of those 7 weeks. Not 5 straight, but the same type of consistency there. And just purely looking at large growth and large value, you've seen an 11% plus outperformance of large value over large growth this year alone. So very different pictures than what we've seen the past few years. There's probably a number of reasons for it. I think we would all like to think that maybe investors are finally seeing value and valuation again. These cheaper segments, cheaper stocks, cheaper sectors have done well this year. And that is pretty common when things get a little bit more uncertain. We look for a bigger margin of safety as the old school deep value name for that. And that's evident in those sectors. And I think you're also seeing, in the case we talked about software last week, that where some of these things that have done really well over the last few years, there just isn't much tolerance for anything that deviates from expectations. So when you have a bigger cushion from that valuation, a lower valuation, it's just a little bit more comfortable for investors, and we're seeing money flow into those areas, and those return better. Will this persist? Will this become another one of those multi-year trends like we just saw the other side of? That remains to be seen. So we'll certainly watch that trend and come back and speak to you more. But I do think this gets to a point that we've said a number of times. We said it with the quilt chart. We said it with some of the managing expectations and the other ways we've tried to help encourage diversification and a breadth in markets. Because you never really know when these rotations happen, and you don't know how long they persist. So having a part of all this and being a part of this market over time, having exposures to these areas lets you participate through various markets. And that's definitely what we'd recommend, even in the current times. So thanks for joining us today.